the investing public.
Yeah, well, let's just say the lack of investing public, because people may not have done the investing that they need because they didn't have the foresight. And it's one thing, again, we said, one thing to actually be a high earning person. There's another thing to have actually accumulated something. It's a different skill, and it's also a different skill to basically maintain
Yes.
that principle and so on. Okay, why is this situation probably going to get worse?
Yeah. Well, I'm not in charge of that, but yes, one of the ways that we can describe the investing public is to say that they're human. The good news is we're all human. Because we're human, we all have emotions. Those emotions cause us to want to spend all that we earn. So it's common for, particularly in America, investors to get their paycheck and have most of it already spent, and what's left is gone by the next paycheck.
Right.
And they have not paid themselves first. That means out of every paycheck, they have a set amount of money that's going into their retirement plan. One of the more popular retirement plans is 401ks. Mm-hmm. The regret is that most people are either not contributing or not contributing the maximum amount or enough into that 401k to meet their retirement needs. Mm-hmm. And the next worst scenario is that upon termination of employment, most people change employers a number of times during their career and their lifetime, that they spend what they received from their 401k rather than putting it into an IRA or their next 401k. So by the time people reach age 55 or 60, they have little, if any, retirement portfolio. And it's very late at that time to start saving for retirement.
Right. I think another thing that you and I talked about is that we have some structural differences that have happened with our generation. I'm putting myself in for you, but there is a little bit of a stretch here between us. Not a whole lot. So, and our parents. So when my father retired and when my father-in-law retired, both of them had defined benefit pension plans. That means that they received a monthly benefit that was based on their salary level with some inflation adjustments. And so this was the common type of retirement plan that most people had. And most people stayed with their employers for a long time in those days. Today, those plans have basically disappeared. And now we have these 401k plans that are, as we said, they're really underutilized. But nonetheless, that's so much of what we depend upon, and it's really just not enough. And so structurally, we're going to have some difficulties. Okay. Well, Craig, I'm going to move along because you said that you want to be sure to cover some material in detail, particularly for the last 15 minutes or so. But I do have one question that I want to throw out before we get into those, and that is, why do people have so much trouble managing their own portfolios?
Oh, great question. Earlier I said the good news is we're all human.
Yes.
Good news is we've all got emotions.
Yes.
Most investors are using those emotions to make investment decisions. We see a mistake in that. The way we describe it in our industry is that people buy when they feel good and sell when they feel bad. The example is in 1999 during the tech bubble. Right here in Silicon Valley was the hub of that investment bubble. And all you had to do was buy one of those .com stocks and the returns were going to bounce off the moon and we were all going to get rich and everybody wanted to invest.
Yes.
Turns out that more new dollars came into the marketplace in 1999 and the first part of 2000 than had ever come into the marketplace before. People felt good. They were excited about investing. From 2000, just pick the most recent downturn, 2008, first quarter of 2009. Markets went down from peak to trough close to 55%, and people didn't feel good. Turns out, studies show that more dollars left the market than in previous history.
Wow.
So people were buying when they feel good in 1999 and the tech bubble, and they were selling when they feel bad when the markets are going down. 2008 is an example.
Yes.
That's the opposite of good investing.
Right.
Good investing says we should be buying low and selling high.
Right.
Most investors are buying high and selling low.
Yes.
So compared to a simple buy and hold of the whole marketplace, what we see is that the average investor is getting about a third of the return of a simple buy and hold of the whole marketplace.
Yes.
So if they didn't have their emotions involved, investors would do better.
Yeah.
And they'd save more, probably.
So the role really, as we said, for the financial advisor like you or asset manager to some degree is to provide some reassurance and discipline to their clients to sort of hold on during those tough times and to be more consistent about how they're doing their investing.
Yes, with a
Okay.
goal in mind of how much they need to save to make their goals.
Right. Okay. Well, with that, we need to move on. So
Okay.
why should I have a risk-managed portfolio?
Well, you need a risk-managed portfolio because history says that's how you're going to make your retirement goals easiest.
Mm-hmm.
Let me explain how a risk-managed portfolio works. Risk management comes from a Nobel Prize concept that was issued in 1990, 20 years ago this month, by the way.
Wow.
Anniversary for
How
it.
about that? Well, we got Nobel Awards coming out. So this is October 13th today,
Yeah.
by the way.
So in 1990, the Nobel Prize was issued for what was called modern portfolio theory.
Yes.
It was a formula on how to mix dissimilar price movement asset classes. We talk about that as like stocks and bonds are different asset classes. And the prices of stocks and bonds do not move one for one. They
Yes.
move differently over time.
Yes.
So if you mix them together, you get a portfolio that's got the least risk. And the formula said, how do we mix those together to get the least risk with the maximum return? So that's what I want to talk about. It's a risk-managed portfolio that takes the least risk but earns the maximum expected returns.
Okay.
So in the first chart,
So first slide.
on the top row shows the S&P 500 with an annualized return of 9.49% over the past 37 years, ending in December of 2008. If you had purchased that index fund in January of 72 and held it through December of 2008, you would have earned an average of 9.49% per year.
So even with that market downturn that we had, you still would have earned 9.4.
9.49% per year.
Okay.
You brought up a good point. If we take out 2008, the returns ending 2007, just 12 months prior, that annualized return for the S&P is closer to 11% per year.
Wow.
So the number that I use is 10%. If you
Okay.
buy and hold the S&P 500 over your lifetime, you're going to earn the market returns, and they have been close to 10%. So that's the kind of return that we would expect in the equity marketplace. A risk-managed, professionally designed risk-managed portfolio is the middle column on that slide. It's titled FWCG Portfolio. And the average annual return for that is 10.31% per year.
Mm-hmm.
And that's after our fees and all the expenses of doing those investments.
Okay.
Basically, it's about the same return as buying and holding the S&P 500.
Okay.
Key to a risk-managed portfolio is that it takes less volatility of returns, or what we call risk.
Yes.
So the second row on that chart demonstrates that the risk of an S&P 500 is 18.65% per year.
Mm-hmm.
But a risk-managed portfolio gets just about the same returns, say 10% per year, but does it with only 15.26% risk per year.